dividend investing,
dividend investing,
dividend income,
dividends,
I'm going to make you fall in love with dividends.
So it seems like everyone else on YouTube is talking about dividends, specifically dividend income investing. And it might be reasonable to assume that the reason why everybody's talking about dividends is because it's the best investment strategy for them, and it's also something you should be doing too.
Nope.
That's Ben from Common Sense Investing. Ben and I agree on a lot of things. And just like Ben, I've got a bunch of weird letters after my name that actually means I'm qualified to talk about this stuff. And in this video, I'm gonna be talking about why these YouTubers are talking about dividend income investing, what's wrong with it, and why it's probably a strategy that you should not be following. Before we get stuck into this, I have to say I have a lot of love and respect for people like Andre Drick, Graham, and the rest of the personal finance community for motivating millions of people to start thinking about saving and investing. Compared with this achievement, arguing about different investment strategies is really just an afterthought. But as an investment professional, it is my duty to you to tell you that these influencers are pushing a strategy that's probably not suitable for them or for you.
Now, what I'm about to say goes against the grain of what pretty much everybody else on YouTube is saying, other than people like Ben, of course. Now, because of that, I know that this video is going to get some hate, but I hope you can see that I'm just trying to show you the other side of the coin. And sometimes this can be hard to see because the YouTube algorithm is constantly working to serve us up information that we agree with that's ultimately just feeding our confirmation bias. So I hope you can see this, and please do a balding middle-aged man a favor and smash that like button.
So let's get started with a quick recap of what dividend investing is. When a company makes a profit, it can either reinvest those profits in new projects, it can use those profits to fund acquisitions, or it can decide to return those profits to shareholders. And they can do this via two means: dividends, which is a simple income payment to shareholders, or via share buybacks, which is where the company goes and buys its own shares from existing investors. Traditionally, dividends have been the main source of returning profits to shareholders. But as you can see here, when looking at the S&P 500, share buybacks have not only been on the rise, but now return twice as much capital to shareholders as dividends. Sorry, I'm getting ahead of myself a little bit there. Dividend investing is a strategy where people focus on investing in companies that are paying high and hopefully growing dividends. These are companies like Coca-Cola, Vodafone, house builders like Barratt Homes, or oil and gas companies like Shell and BP. All companies that make significant profits and have a long history and expectation to pay dividends to shareholders, who, on receiving these dividends, can choose to reinvest them and benefit from compound growth, or they can just live off the income. Now, there are four main reasons why people use dividend income investing: to generate income, to achieve market-beating returns, just because they absolutely love it, or because somebody on YouTube told them that it was a good idea. I'm going to show you the flaws in each of these reasons, but let's just start with that last one. Why would someone on YouTube be pushing a strategy that's not suitable for them or for you? Well, it has everything to do with this: passive fucking income. Over the last 10 years, there has been a surge in people searching for passive income ideas. And you might think, okay, that makes sense. We've got an aging population and they're all probably getting close to retirement and they're probably working out how they can make an income.
Nope.
Thanks, Ben. No, as it turns out, it's people like you and me, young people, that are searching for this stuff. And I get it. We all want to earn more income. And if there's a way that I can earn income passively without having to do anything, then brilliant, I want to find out about it. So if you're a YouTuber and you see that millions of people are searching for this stuff, then of course you're going to jump on the bandwagon. You want to grab some of those views. And what better thing to talk about than dividend income investing? This magical strategy that just pays you money into your account every month. But the problem is, like most of these passive income ideas, they're not passive at all, and they require a huge amount of investment up front, either in time or capital. And if you want to earn more income, you have got a far better chance of earning it actively, so through your job and career, by investing in yourself and learning skills that are going to increase your own value. Investing in yourself can reap you far, far higher returns than investing in the stock market. I have made a whole video on this, so please do check it out. Now, don't get me wrong, I'm not saying don't invest in stocks. I love the fact that you are so passionate about this, but instead of investing for income now, you should be looking for whatever strategy is likely to give you the best total return, so that when you do actually retire and want to create an income in 20, 30, 40 years time, you have the biggest pot to do that from. So rant over, let's get into the facts. Dividend investing to generate income. Investing in dividend paying stocks is something that's often done by people looking to generate an income from their assets. But there are two big problems with this. The first of which is that you need an absolutely massive portfolio to make this work. With a well-diversified portfolio of dividend-paying stocks, you would, at a push, be able to achieve a yield of about 3.5%. So if you were trying to generate an income of £30,000, you would need a portfolio in excess of £850,000. Now, I don't have that much money, and neither do you. And the second reason is that dividends are a really inefficient way of generating income. Whether a company pays a dividend or not has no effect on your total return as an investor. Let me try and illustrate this. If you had investments in two different companies, A and company B, that were both valued at £10, and then over the course of the year, both companies make profits and their share price goes up to £11. Now, company A decides to pay out some of those profits as a £1 dividend. And because of this, you'd expect the share price to go down by the same amount of the dividend. So you, as an investor, will be left with £10 in stock and £1 in cash. On the other hand, if you wanted to create an income from company B, you could simply sell stock to the same level as the dividend of company A, and that would leave you in exactly the same position, with £10 in stock and £1 in cash. But that's not quite true. Because dividends are taxed as income, if you were trying to generate an income of £30,000 a year solely from dividends, you would be left with a tax bill of over £3,000. Whilst generating that income from only selling shares, which would be taxed as a capital gain, would only at the very most cost you £1,750 in tax. However, it's much more likely to cost you nothing at all. In fact, the most efficient way to generate income as an investor is to balance it between sources that are taxed as income and sources that are taxed as gains. And the reason for this is so that you can make use of the generous tax-free allowances that are offered on both of these. The other problem is that you have no control over when you receive these dividends or how much you're going to receive, which can be an absolute nightmare for trying to manage cash flow. Because some months you could end up short and some months you could end up with far too much. On the other hand, creating an income via selling assets gives you much more control over when you receive that money and the amount that you receive. And if this is done in a systematic way, it can remove the stress around whether it's a good time to sell or not. And because you have the option of not receiving that income and you can keep it in the company, it allows you to defer any potential tax payments to future years. And this is probably one of the main reasons why investors prefer share buybacks to dividends. Dividend investing for beating the market. It is true that companies that pay dividends and have a policy of actively growing that dividend over time have produced absolutely outstanding returns. Since 1999, the S&P 500 Aristocrats Index, which is a collection of companies that have previously paid high and growing dividends, has beaten the S&P 500 by a whopping 3.37% on an annualized basis, which is just insane. There is absolutely no denying the outperformance of these companies. But there are two very, very good reasons why focusing on dividends is not a good way for you to try and replicate these returns. And the first reason is that dividends are not the reason for these excess returns. And this is what so many people get wrong. So many people assume that the dividends themselves are the reason why these stocks have outperformed, and this leads to people dividend hunting and building portfolios entirely based off the dividends that companies pay. But in fact, the main reason why this group of companies have outperformed is because they tend to be high quality companies with exposure to risk factors like value and profitability. And it's exposure to these factors that is the real reason for why these companies have outperformed. However, high quality companies that have exposure to these factors that have been proven to generate these returns do not always pay dividends. Likewise, companies that pay dividends do not always have exposure to these factors. So yes, by building a portfolio entirely of dividend growth companies, you may accidentally pick a group of companies that have exposure to these factors, but you'd be much better off just by looking for companies that have these factors in the first place. If you need more convincing on why dividends are irrelevant, I would highly encourage you to watch Ben Felix's video on the topic. It's probably the most passive-aggressive thing you'll see on YouTube. The second reason why focusing on dividends will not help you produce these returns is because of diversification. Dividend investing often leads investors to buy and hold individual companies. And you can find lots of people that have had great success in doing so. But this has nothing to do with their strategy and everything to do with luck. It is a mathematical truth that 50% of investors will outperform the market and 50% of investors will underperform the market. But by choosing to invest in individual companies, you are making an active decision to own a subset of the market in the hope that you can outperform it. But because you're only holding a small set of individual companies, you're not going to benefit from diversification. And because of this, as you can see here in this graph by Vanguard, the dispersion of your returns is likely to be much higher than someone that invests through an index fund. So where the market return may oscillate between a 20% up year and a 20% down year, your portfolio's yearly returns are likely to swing much further beyond that. And this volatility is going to fuck with your head, because at the end of the day, we're all just a bunch of talking monkeys that are ruled by fear and greed that leads us to buy at the top and sell at the bottom. In fact, a recent study from Dalbar showed that because of this irrational buying and selling, your average retail investor has only achieved an annual return of 1.9% over the last 30 years. But it doesn't stop here. Because high dividend paying stocks only make up about 40% of the market, and these companies are limited to certain sectors, you're gonna see long periods of underperformance. In fact, dividend paying value stocks have significantly underperformed over the last 13 years, including the recent crash in March, where you would have expected them to outperform. Now, imagine if you were a dividend income investor and you had a goal that you wanted to buy a house in 10 years' time. Or maybe you even wanted to retire. And then year after year, you're sitting there seeing lackluster returns while the rest of the market is booming. It's not gonna feel good. And that little chimp inside you is gonna get very, very angry, and you're probably gonna do something stupid. As an investor, you're very quickly gonna realize that the biggest challenge that you're gonna face is actually you. So please don't poke that chimp and make sure your portfolio is properly diversified. Dividend investing because you just love it. Okay, I have something to admit here. I am a dividend income investor. No, okay, that's not true. But people that genuinely do love reading dividend income blogs and trawling through dividend income statements year after year are likely to end up with a much bigger retirement pot than the average investor. But this has nothing to do with the returns of their strategy and everything to do with their passion for it. Because it's that passion that gives them the motivation to keep saving more. It gives them the persistence to keep at it, and it gives them the interest to keep learning more and more and more about other areas of finance. So if you do genuinely love it and you have the time to do it properly, then go for it. But just keep in mind that if your goal is to maximize your returns, then technically this is not the optimum strategy to be following. And I bet that you'd be just as motivated following a strategy that is.